Welcome, curious minds, to another deep dive. Today, we're taking a shortcut to being well-informed on a topic that truly touches all of us: wealth creation and smart investing. Especially, in today's incredibly dynamic markets. It's got a fascinating set of sources today, delving into the insights of a really seasoned expert.
Indeed. We're unpacking a recent interview with Pankaj Tibrewal. He's the founder and CIO of Eek Asset Managers.
Right.
And this is a man with, well, over 2 decades of investing experience.
Wow.
Yeah, including managing a staggering $7 billion in AUM, that's assets under management, back at Kotak Mahindra AMC.
$7 billion, that's serious.
It is. And his decision, leaving a large firm like that to start his own, Eek Asset Managers, just a little over a year and a half ago. Well, it says a lot about his conviction.
Absolutely. Yeah. And he's definitely earned his reputation as one of India's leading mid-cap fund managers. So our mission today is really to extract the most critical nuggets from his experience, his unique philosophy, offer you clear, actionable insights, whether you're just starting your investing journey or, looking to refine your approach. We're going to dive into what truly builds enduring wealth, according to him.
Yeah.
Okay, so let's start with his core philosophy for younger investors. He makes this crucial distinction, almost counterintuitive. Growth is accidental, but survival isn't. That kind of shifts the focus, doesn't it? From chasing winners to just avoiding the big mistakes.
Yeah.
What does that mean practically?
Well, what's fascinating is exactly that emphasis on survival. He argues that knowing what not to do, that process of elimination, is actually far more critical than trying to pick the next Amazon or Google.
Right. Avoid the landmines first.
Precisely. He even has this quip saying after 4 years where all horses and donkeys ran, meaning, everything did well.
Yeah, the easy times.
Say, it's now time for the horses to really shine.
The market gets discerning. And key to this survival, he stresses, isn't just raw IQ. He really believes your emotional intelligence, your EQ, often trumps IQ in the equity markets.
That's profound. So it's about temperament, not just calculation.
Exactly. Not getting swept up in the hype or the panic.
Okay, so to help us avoid those landmines, he outlines 3 core principles. Let's start with the first. The promoter. He suggests an astonishing 80% of an evaluation is about the person running the business. 80%. Why so much weight on the human factor?
Well, his reasoning is pretty straightforward. Promoters can both build and destroy companies. It's their conviction, their integrity, their vision that really steers the ship, especially when things get rough.
Okay, so how do you identify the right ones?
He recommends backtesting their history. His line is, tigers don't change their stripes.
Track record matters.
Hugely. Past behavior is a strong indicator. And get this, he actually uses LinkedIn.
LinkedIn for investing?
Yeah, to track senior level attrition, high turnover at the top, maybe a red flag about the culture or the promoter. He also suggests, leveraging your network, maybe talking to chartered accountants to understand a promoter's personal financial health. He thinks it often mirrors the company's.
That's a fascinating, almost forensic approach, social media for due diligence. He also mentions a sweet spot for promoters, doesn't he, age-wise?
Yes, typically between 40 and 60.
Okay.
He cites examples like Rajiv and Sanjeev Bajaj, Uday Kotak, the Infosys founders. His thinking is, by 40, they've seen a few market cycles, gained some humility.
Right, learn some lessons.
But they still have that fire in the belly, that drive. He gives a specific example, too, Aman from Courant Pharma. Even though he's in his late 30s, he's earned immense respect and helped grow the company massively. From 15,000, 20,000 crore market cap to over 1 lakh crore.
Incredible growth.
It really is. And it underscores his point. Even in a tough industry, a strong promoter with conviction finds a way through the inevitable drawdowns. He talks about these 5 S-curves a company faces.
S-curves, what are those?
They're like distinct growth phases where new challenges pop up, lack of credit maybe, or talent, technology, finding new markets, new products, and the right leadership is just paramount to navigate each of those transitions.
Got it. So, promoter first. Pillar 2, cash flow. This is where it gets really interesting, he says. He emphasizes just looking at profit, or EBITDA, or even top-line growth. It's not enough. PAT and EBITDA growth without matching cash flow is a recipe for disaster. Why is that such a critical point?
Because, paper profits aren't real until they're cash and bank. It's that simple, fundamentally.
Right, you can't pay bills with EBITDA.
Exactly. The biggest compounders, the real wealth creator, he explains, are companies that consistently turn their earnings into actual cash flow. And then, crucially, they reinvest that cash smartly back into the business. That fuels organic growth. He gives a great example, Sundaram Finance. For 50 years, they've never raised external capital.
50 years.
Because their return on equity, around 16, 18%, consistently matched their growth rate. So they could just keep recycling internal funds. No dilution, pure compounding.
That's powerful. And he gives us a rule of thumb, right?
It does, a very practical one. Look for companies where at least 70% of their EBITDA converts into cash flow from operations.
70%.
And look at that over a, say, 3 to 7 year period, not just one quarter. Anything less, he warns, is a serious red flag. He points to companies like Cox & Kings, 8K Miles, Mampasan Beverages. They showed high growth on paper.
Yeah, I remember those names.
But their 5-year cash flow conversion was terrible, like 22, 25%. And we know how those stories ended. He sums it up perfectly. Top line is vanity, bottom line is sanity, and cash in bank is reality.
Vanity, sanity, reality. I like that. Okay, pillar 3, return on capital, ROC. This is the final filter.
Yeah, a crucial one. His point is direct, almost blunt. If a company generates returns below the cost of capital in India, he puts that around 11, 12% return on equity. You might as well just put your money in a fixed deposit. Why take the equity risk for less return?
Makes sense. Risk versus reward.
Exactly. And he defines ROC pretty standardly. EBIT, that's earnings before interest and taxes, divided by capital employed, which is basically net worth plus debt. He notes, if you rigorously apply these 3 filters, good promoter, strong cash flow, healthy ROC, you can cut down the, 3,600 actively traded companies in India?
Yeah, a huge number.
Down to a much more manageable list, maybe 350, 400. That immediately improves your odds.
Okay, so filtering helps massively. But is it just about finding companies that already tick all these boxes? Or is there something more?
That's where he brings in this idea of the rate of change. This is subtle but important.
Rate of change.
Yeah. He argues the biggest money often isn't made in companies that already have, say, a super high 25% ROC. It's often made when a company transitions. Goes from a mediocre ROC, maybe 11, 12%, up to a much better one, like 18, 20%.
So spotting the improvement is key.
Exactly. Maybe they shed unproductive assets or management gets serious about efficiency. It's about understanding if the fundamental nature of the company is changing. That requires deeper analysis beyond just screening.
Okay, that makes sense. It's about the trajectory. Now, let's shift gears. Where does he see opportunities? He mentions a mistake from his early career, focusing too much on just the absolute PE ratio. What was the lesson there?
He realized, as he puts it, growth is the horse and valuation is the card.
Growth is the horse.
Meaning growth is what drives the returns, ultimately. Valuation is just the price you pay to ride that horse. So now he advises looking at the PEG ratio, price earnings to growth.
PEG ratio, right.
If the PEG is less than 2, say you're paying a PE of 50 for 40% growth, the PEG is 1.25. That's generally a good sign. Provided, and this is a big caveat, your earnings forecasts are reasonably accurate.
Of course. Garbage in, garbage out.
Precisely. But PEG gives you a better sense of whether the price is justified by the expected growth.
Okay, so using that lens, what sectors look promising to him over the next, say, 5 to 15 years?
He's particularly bullish on consumer discretionary.
Interesting. Not staples.
No, not the basic FMCG stuff, which he feels is already well penetrated. He's talking about new categories, driven by India's rising disposable income as the economy grows from, $3 trillion towards a projected $10 trillion.
So what kind of categories?
Think value retailing, airlines, hotels, liquor, and especially wellness. That's a huge emerging theme. Hair care, weight loss, fitness, things people spend on when they have extra money.
Wellness makes sense. What else is on his radar?
Manufacturing. But with a specific angle, India moving beyond just being a processor for a global company.
Right, like assembly work.
To actually owning its own intellectual property IP and building its own platforms. He actually expresses some disappointment here with Indian IT services.
Oh, how so?
Well, he says, look, they have the best engineers, great leadership, billions in cash. But they largely lacked the risk appetite to build their own products. They preferred buybacks and dividends over really investing in R&D for platform creation.
That's a critique you hear sometimes?
Yeah, and he contrasts that with someone like Sanjeev Bikhchandani of InfoEdge. He used the cash flow from Naukri,
the job portal,
to fund startups like Zomato and Policy Bazaar. Turned an initial investment of maybe 250 crore into like 35,000, 40,000 crore.
Wow. That's incredible foresight and risk-taking.
It really is. But he doesn't think it's a lost game for Indian IP.
No. What's the path forward?
He argues the large companies could easily carve out, say, $1 billion to fund and mentor startups, especially in crucial areas like AI, where India is currently lagging a bit. He feels India simply cannot afford to lose this AI battle, having already missed the boat on Industrial Revolutions 1.0 and 2.0. So his message to big corporates is clear. Fund these disruptive startups, own the IP, build the platforms, don't just be service providers forever.
A strong call to action there. Okay, moving beyond sectors. He talks about hard assets and geopolitics. This feels like a bigger picture, longer-term theme.
It absolutely is. He argues that over the next decade, hard assets, commodities, metals, etc., are likely to outperform software.
Really?
Several reasons. The current interest rate environment is one factor. Geopolitical tensions are another. But he highlights a really significant shift in China's stance.
What's that?
China seems to be moving away from exporting deflation, super cheap goods, towards actively fighting deflation. That means closing excess capacities, maybe raising prices. And if China stops exporting deflation...
We could see inflation in commodities return globally.
Exactly. He's already seeing signs like rising steel and lithium prices after some key mine closures.
Okay, so if commodity inflation is a theme, which specific metals does he think look interesting? Any dark horses?
He points to two. Copper and silver.
Copper and silver.
Also, he notes, is at a historically low ratio compared to gold. But its industrial uses are booming: EVs, data centers, power transmission. And global supply is really constrained. U.S. copper production, for instance, has halved in 15 years. New mines take 15-20 years to come online.
Wow, that's a long lead time.
It is. And silver also has significant industrial usage. It's not just a precious metal. So he suggests considering maybe a 5–10% allocation in your portfolio to precious or non-ferrous metals as a hedge and for potential growth.
What about gold? It's already run up quite a bit.
Gold, too, he thinks, has strong tailwinds. A big factor is central bank buying. Central banks have bought more gold in the last 3 years than in the previous 21 years combined.
It's a huge shift. Why?
It seems to be about diversification away from the U.S. dollar and treasury bonds. It points towards a potential long-term macro trend of de-dollarization. Power shifting away from the U.S. dominance towards other nations, making hard assets, maybe even some digital assets, more prominent stores of value.
But he does add a word of caution about just speculating wildly, right?
Oh, absolutely. Extreme care needed, especially with highly speculative things like crypto. He reminds us of the huge losses when Bitcoin crashed from, $80,000, $90,000 down to $30,000. It's about thoughtful asset allocation, strategic positioning, not betting the farm on risky assets.
Right. Okay, let's talk about navigating the market right now. For a lot of listeners, it might feel frustrating, maybe sideways movement, not much money being made easily.
Yeah, and he acknowledges that feeling, but reminds us it's not new. He points back to the period from 2000 to 2003. After the tech bubble burst, the Sensex basically went nowhere for 3 years. Stuck between 2,500 and 3,000.
3 years of stagnation. That sounds frustrating.
Very. But he calls that frustrating phase the investing phase. Because making the right investments during that consolidation or correction, that's what can yield really decent returns over the next 3 to 5 years. He actually thinks this current period, with all the geopolitical noise and uncertainty, is ideal for doing your homework. Deep research, finding quality.
So turn the frustration into research time. What specific advice does he have for, say, the average 30-year-old listening right now, wanting to build wealth in this kind of market?
Well, first, he says, focus on your core competence, what you're good at in your career. If investing isn't your expertise, consider leaving it to professionals. You could lose both time and money trying to do it yourself badly.
Sensible advice.
Second, find a trusted financial advisor early on. He calls it finding your Sarathi, your charioteer for the journey. And crucially, diversify your assets. Don't put all your eggs in one basket. But underlying all this is his firm belief that India's best days are still ahead. He emphatically says 90% of the country's wealth creation is yet to come.
90%. That's incredibly optimistic.
It is. He points to the young population, average age 28-29, and corporate India's overall health, like an aggregate 15% ROE. He sees huge potential.
Now, he also gets quite personal, sharing insights from his own journey. His 3Ms, Marwari heritage, Manchester education, markets experience. What are the key lessons there?
He stresses that investing for him is a 247 job. It has to be driven by passion, a constant hunger to learn. But he's also incredibly humble about his success. He attributes a lot of it, overwhelmingly, he says, to luck. Yeah. Being born into the right family, the right country at the right time, finding great mentors like Vinay Gotia, Nilesh Shah, Uday Kotak. He believes time is more powerful than any individual, and gratitude is absolutely essential.
That's a remarkable perspective from someone at his level. What about advice for youngsters trying to break into finance today?
He really encourages them to just reach out. Don't be afraid to connect. He tells a story about a brilliant CA rank holder who got a job on his team simply because he took the initiative to reach out.
Proactiveness pays off.
It does. He also stresses developing the right temperament, being able to take criticism from mentors, seeing it as a learning opportunity, not a personal attack. That's crucial for growth. And maybe most importantly, read a lot. Anything and everything. It just expands your horizons, helps you connect dots.
Connect the dots. And the single biggest lesson from all his mentors, he boils it down to one word, right?
Yes. Humility.
Humility.
Yeah. He believes arrogance, he uses the analogy of Ravana from the Ramayana, will inevitably be humbled by the markets, by life. So he champions equanimity, maintaining balance, not getting too high in the good times, not too low in the bad times. Understanding both phases will pass.
How does he cultivate that equanimity, especially in such a volatile profession?
He credits practices like meditation and vipassana. He says they help foster inner clarity, cut through the market noise, avoid that FOMO fear of missing out. He genuinely believes spirituality provides an anchor, especially when you're managing other people's hard-earned money. It brings responsibility and perspective.
That makes sense. Now, to make these ideas really concrete, let's talk about a specific stock story, a multi-bagger. He mentioned solar industries.
Yes, solar industries. It IPO'd back in 2005-06, market cap around 1,500 crore. It's a great case study for his principles. They were initially very dependent on coal in India, but the promoters had a clear vision to diversify into the private sector and exports. What was really remarkable was their consistent growth while raising very little external capital, only about 800 crore since the IPO. That screams strong cash flow generation.
Okay, strong fundamentals. But was it just a smooth ride upwards?
Oh, far from it. That's the key lesson here. The stock went through long periods, like 2 or 3 years sometimes, of underperformance. There was promoter infighting at one point, demand issues, the usual business challenges.
So what's the takeaway?
Patience. His biggest lesson from that journey was having the conviction to hold through those bad phases, maybe even add more when things looked bleak rather than panic selling.
Holding conviction through tough times. And they also took some big risks, didn't they? Like investing in defense.
A huge risk. Back in 2015-16, they invested about 8,000 crore into defense. For years, it generated zero revenue.
Zero revenue for years. That takes guts.
Absolutely. Government orders, validation processes, it all took time.
Yeah.
But when it finally paid off, it was massive. He mentions their drones were even used in a critical operation called Operation Sindor. They became a leader in private sector defense tech. And crucially, the promoter didn't cash out. They maintained a large stake, around 75%. That shows long-term belief.
So the promoter's conviction again.
Exactly. He says that's the hallmark of a true multi-bagger journey. No one knows up front it will be a multi-bagger. It requires continuous watching, patience, and conviction through thick and thin.
Which leads perfectly into his really unique concept, sleep-adjusted return. I love this phrase.
Me too. He says, people talk about risk-adjusted returns, but I believe it's more important to have sleep-adjusted returns.
Meaning?
Meaning, if an investment keeps you awake at night worrying, it's just not worth it. Even if it means potentially sacrificing a tiny bit of extra return. It's about finding those solid companies, those trustworthy promoters, the jockeys and vehicles, as he calls them, that let you invest with peace of mind. Aligning your portfolio with your well-being.
Sleep-adjusted returns. That's a great principle for life, not just investing. So, wrapping up, for anyone listening who feels maybe India's big growth story is fading or the best days are gone, what's the final word from our expert?
He is unequivocally a Super Bowl on India. He emphatically repeats, 90% of the country's wealth creation is still ahead of us.
Wow. Still maintains that conviction.
Absolutely. He reminds us, look, India has navigated crisis after crisis, the dot-com bust, political changes, the global financial crisis, GST, RERA, COVID. And through all that, the Nifty index still delivered a 13% compounded annual growth rate over 20 years. That's resilience. He even quotes Larry Summers, who apparently quipped, Japan is a hospital, Europe is a museum, and China is a jail.
Ouch. Strong words.
Yeah, positioning India and the U.S. as really the prime destinations for investment for the foreseeable future. his dream. He hopes to see maybe 10 Indian boutique investment houses achieve global stature in the next 10-15 years, like Prashant Kempka has done with White Oak, and he hopes asset managers can be one of them.
That's a powerful, really optimistic vision for India's future, grounded in some very practical strategies and, well, a deep personal philosophy, too. What a fantastic deep dive.
It really covered a lot of ground, didn't it? From stock-picking principles to macro trends to personal humility. And if we connect it all back, it really is about playing the long game. For the country and for you as an investor, maybe the most provocative thought to leave everyone with is this. In a world that's just full of noise, constant short-term distractions, that urge to chase the next hot thing, how much are you willing to invest in your own sleep-adjusted returns, both financially and, personally, to really thrive, find that balance for the long run?